This video looks at unanticipated and permanent increase in real GDP, domestic real income or domestic real GDP. It's again a flexible exchange rate regime. It's our 5th video in the series. It's a little bit unrealistic of an experiment because real GDP doesn't tend to just jump up, but it works us through the mechanics of the model a little bit, so we're going to explore it real quick. So first thing to note, the foreign nominal money market is totally unaffected. The foreign money market is not affected. Everything stays as it is, totally unchanged. No need to do anything there. We start in steady state. Everything is cruising along in equilibrium over time when suddenly real GDP increases. When real GDP increases or real income increases for the individuals in the domestic economy, domestic nominal money demand increases because you have higher income. You'd like to have more physical units of cash in your pocket to spend. So, real GDP increased, increasing the liquidity portion of the money demand curve, increasing interest rates. So we can tell, and it's permanent, that the effect down here is just going to be that. Nominal money supply doesn't change. Nominal price level doesn't change. Real money doesn't change because M over P doesn't change. So the rest of the market looks like that. Pretty boring. This increased. We can see that it's going to do that here. So this increase gets translated over to here. In the foreign exchange market, increasing the return on domestic currency or domestic assets, lowering the nominal exchange rate. That turns out to be permanent as well. A couple of quick things to note. Well, first of all, this is a permanent increase in the value of domestic currency. We see that in two places. It's a drop in the exchange rate, the nominal exchange rate, which means the value of the domestic currency has gone up. And that's reflected over here in the price of domestic currency, which is the nominal interest rate domestically. You might also wonder, well, if money didn't change and prices didn't change, inflation hasn't changed, so how is the nominal interest rate higher? The nominal interest rate, if you remember, is the real interest rate plus inflation expectations. This piece didn't change, but for this to have gone up, the real interest rate had to rise. That makes sense because the whole change is being driven by a real increase in real GDP and output, which means the value of capital has gone up in production process, which has raised the real interest rate. If you had a savings and investment diagram, a loanable funds diagram, you would also see that a real increase in GDP would increase investment opportunities and also increase the real interest rate. So the nominal interest rate permanently rises. These things don't change. And as a result, we get a higher interest rate in equilibrium. Two quick notes. It is a permanent new steady state. We reach this newer steady state. This is higher than the old steady state. But we didn't get an increase in expected interest rates here because you didn't have time. Once this suddenly happened, this increase in real money demand pushed up interest rates immediately. There was no transition. There was no time when I knew interest rates would rise to a new steady state level and I had some time to do anything about it. They just happened overnight. So as a result, the expected interest rate component here never changed. We'll see that show up in another case where it does.